Today is the 6th of February 2021, and in today's market update we're going to be taking a look at the price of gold. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. It has been a long time since I did a market update about the price of gold, and one of the reasons for that is because any discussion about the Hurst cycle analysis of the price of gold requires a discussion of where the cycles should be synchronized. Should they be synchronized at their troughs or at their peaks? So to provide a little bit of background in case you are not familiar with this discussion, you will see that on this chart I have two analyses. I have an analysis at the foot of the chart, which is a marking of the position of the troughs of the cycles that have been found in the price action. And at the top of the chart, I have a separate analysis which marks the position of the peaks of the cycles that have affected the price action. Now, most people, when they first encounter Hurst cycles, assume that what I am speaking about here is in fact one set of cycles that is moving from a trough up to a peak and then back to a trough, up to a peak, and so forth. But in fact, what I have displayed on this chart is two entirely separate analyses. This is what we call a dual analysis. And the reason for that is a little too complicated to explain in great detail in this video, but I will give you a brief introduction to this so that you can understand what it is that we're speaking about. First of all, when Hurst defined his approach to the way in which cycles influence the price action of financial markets, he listed the cycles that he found in the markets that he studied, which were, of course, mostly stock markets, the US market in particular. He studied thousands of US stocks over many, many years, and he identified cycles which were influencing the price action of those stocks. And he discovered that the cycles that were influencing those stocks were synchronized at their troughs, which meant that they tended to experience troughs at the same time, which is why when we look at an analysis on a chart of a stock market, we are looking at a stack of diamonds at the foot of the chart, because the stack of diamonds represents the position of the troughs of multiple cycles. The taller the stack of diamonds, the more cycles are experiencing a trough at that point. The higher up you go in that stack of diamonds, the longer is the wavelength of the cycle that is experiencing a trough at that point. And because the troughs are synchronized, those stacks of diamonds occur. In other words, the troughs are occurring simultaneously or synchronously. Okay? And mathematically, the result of that is a price action that looks very much like the kind of price action that we see in a stock. Now, when you look at this chart, you might say to me, well, that looks very much like the chart of a stock market. But in fact, there are some very clear and obvious differences. And let me point out some of them. In most stock markets, you tend to find very sharp and isolated low points in the price structure, whereas the high points or the peaks in the price structure tend to be fairly rounded. However, look at the price of gold here. Here we have a peak, which is a very sharp, isolated peak. There is no debate as to whether this is the actual peak that occurred then or whether this is, because this is a sharp, isolated peak. Similarly, we have recently had another sharp isolated peak. But before we get to that, let's consider the troughs. As you can see, troughs tend to form in a sort of a clustered, rounded shape in the price of gold. And you can see it over here as well. So that is something that is fairly unique to gold and to other precious metals and in fact to many commodities. But the point is that it's very different in a stock market. I'd encourage you to have a look at stock markets. I'm not going to spend time in this video comparing the two because we don't need to go into that much detail in this video. But in most stock markets, you will discover the opposite, which is that you get very sharp isolated troughs and you tend to get rounded and clustered peaks, which is why identifying a peak in the stock market is often a very difficult thing to do because you will have one peak and then you'll have another peak and then you'll have a third peak and so forth, and it becomes very difficult to actually identify the real peak. However, gold, as you can see, tends to have sharp isolated peaks and rounded clustered lows or troughs. I should point out this is not something that Hurst observed. It's something that I observed, and in discussions with Ray Tomes, who has a theory called the harmonics theory, which is a theory about cycles and the way in which they affect everything, not just stock market prices or financial market prices. In discussions with Ray Tomes, he suggested that perhaps in gold and silver and other precious metals and in commodities, the cycles are not synchronized at their troughs, which would mean that a cycle analysis based on synchronized trough cycles might be incorrect, but that they are perhaps synchronized at their peaks. And that is what gives us this particular sort of formation with the rounded clustered troughs and the sharp isolated peaks. And indeed that seems to be the case. And in fact, that is why Sentient Trader is capable of performing what we call a dual analysis, where we can analyze the troughs and we can also analyze the peaks. And I should state that a little more clearly. We perform an analysis based on the concept that the cycles are synchronized at their troughs, and that is displayed at the foot of the chart. That's this analysis here. We then perform a separate analysis, assuming that the cycles are synchronized at their peaks. So I'm not going to go into much more detail about this concept here. I would encourage you to experiment with this idea because it's a fascinating thing to study. The important point that I wish to make in this video is that generally an analysis of gold performed at its troughs is not really a very clear and satisfying analysis. Often you'll find the analysis doesn't really match the price action very well. You can see I've pinned this analysis, and so I have forced it a little bit. And indeed the analysis doesn't look too bad. You can see that we have troughs at positions that are clearly troughs in the market, but it's just not really a very satisfactory analysis generally, the trough analysis. And I know from experience that trading on the basis of a trough analysis in gold is a fairly difficult thing to do because you are often misidentifying the position of the troughs in the price action. I did a lot of work with a wonderful Hurst analyst and a wonderful man called John Eastreich, whose avatar was Silent One. I've mentioned him in many videos before, and I've done webinars with him. Very sadly, he passed away a little over 2 years ago. He was a wonderful gold analyst particularly, and he did a lot of research, and he believed that the cycles that influence the price action of gold are either shorter or longer than the nominal model. And I say either or because if you choose a nominal model, which is a structured list of cycles, and you shorten them, then often you end up with the same cycles as if you were to lengthen them. If you don't understand that, take a look at a nominal model and try it out, and you'll find that you can end up with a very similar nominal model whether you shorten or whether you lengthen. So Hurst, in his writings about gold, mentioned that the cycles in gold seem to stretch longer. And if you look at the right-hand side of this chart, and you can see the average wavelength that has been found in this analysis, you can see that the cycles are much longer than are normally expected. 20 months instead of 18, 62 instead of 54, and a 10.3-year cycle instead of a 9-year cycle. And so even now, almost 50 years after Hurst wrote his cycles course, we are also finding longer cycles. However, I observed, as soon as I was able to apply a Hurst Cycles analysis using Sentient Trader to the peaks, that in fact the peaks seem to really match the original cycles found by Hurst much more closely. And so let me zoom in on this chart and speak about something that has happened recently in gold, which is that it has apparently come up and formed a peak. And you can see that according to this analysis, that has been tagged as a peak of the 9-year cycle. And the previous time that we encountered a peak of the 9-year cycle was back in the middle of 2011, which is this big peak over here. So let's measure the distance between those peaks. First of all, before we measure the distance, let me write down here the length of days that Hurst discovered 50 years ago in his research for the 9-year cycle. And he discovered that there were 3,276 days in a 9-year cycle. And in fact, if you read the Profit Magic or Stock Transaction Timing, he comes up with a slightly different figure. The Hurst Cycles course that he wrote after that book has the figure of 3276. And if we measure the number of days, and I need to position my mouse fairly carefully to get this right, if we measure the number of days from the 2011 peak to this peak that we encountered, it was, I think it was in early August, or was it the end of July of 2020? And if I bring the mouse down a little bit, you can see that there were 3,259 days between those peaks. Okay, so that's a difference of only 17 days. That distance is very close to the 9-year cycle length that Hurst discovered 50 years ago in terms of affecting stock markets, which are influenced by cycles that are synchronized at their troughs. Now, it is my belief that gold is influenced by cycles that are synchronized at their peaks. It's a really interesting idea that I would encourage you to explore and look at. But very clearly, the peak that formed in the middle of last year is, according to this understanding that the cycles are synchronized at their peaks, is a 9-year peak. And it differs, as I've pointed out, by only less than 20 days. So less than 20 days over a 9-year time span is a really pretty extraordinary result. I'm sure you will agree. So what does all this mean? Well, it means that I believe that a 9-year cycle peak formed over here in the middle of last year. So what's going to happen now? So what we will do is we will zoom in a moment, but before we do that, let's zoom back out again and let's take a look at our composite model line. The composite model line is a very useful tool for providing us with a way of interpreting an analysis. What does the analysis mean? That's what the composite model line does for us. So we have a big 9-year peak over here at the middle of last year. The last time we had a 9-year peak was in the middle of 2011, and as you can see, the price of gold went down for quite a long time, 4.5, almost 5 years. I did a webinar at the end of 2015 with John Eastreich, whom I mentioned a moment ago, and you should certainly take a look at that because he predicted that gold was about to turn up, which it did, of course, at the end of 2015. So initial and obvious thing to say is that seeing as we've just encountered another peak of the 9-year cycle, the chances are fairly good that we're going to witness price of gold dropping down again. Where is it going to drop down to? Well, if we have a look at our trough analysis, and this is where the concept of a dual analysis becomes fairly interesting, because we can look at both analyses and see what information we can gather from each, and that analysis is predicting a trough in about 2024. Certainly the next really big peak, the 9-year peak, is only expected is at the end of 2028, I think. So we've got a long way to go until we can expect the next peak to form in the markets. So let's take a look at this composite model line, because as I've mentioned, the composite model line is a very useful way of understanding the implications of the analysis. And there is a composite model line, this dashed orange line, which, as you can see, tells us that the implications of this analysis are exactly as I have drawn with these arrows, which is that the price of gold is expected to move down. It's predicting a slightly earlier trough than this one over here. That is because of the combination of the peak and the trough analyses. And so it is predicting a low price in about 2023, after which point the market is expected to turn back up again and travel up to new highs to reach its peak at the end of 2028. Now let's zoom in and see what we should expect coming up soon. So I still have both analyses on this chart. The concept of a dual analysis is a really fascinating one. I hope that it doesn't confuse you. You can gather useful information from both analyses. Generally speaking, one analysis is always better than the other, and you should always favor the one over the other. In this case, I always favor the peak analysis when it comes to gold. In stock markets, I also look at a peak analysis, but I always favor the trough analysis, which is why I usually only show the trough analysis in these videos. But here we're going to just take a look at both analyses, and you can see how the composite model line matches price action fairly well because it is considering both analyses. And you'll notice, of course, there is the big peak in the middle of last year, and price has been dropping down. But of course, price doesn't drop down in a straight line because it's got all the shorter cycles to contend with. And you can see that in our trough analysis, we had a fairly clear 40-week cycle trough at the end of November last year. And then the price of gold bounced back up again and reached a 20-week cycle peak pretty much right at the beginning of this year. I think that was in the first week of 2021. And you'll notice a discrepancy between the composite model line and price. The composite model line expected price to come up higher and in fact almost to match the peak that formed in the middle of last year. But price failed to do that. That is a bit of a bearish sign. It indicates that price is not managing to fulfill the expectations of the cycles that are influencing it, if that makes any sense. The fact that price couldn't get up to where the composite model line was indicates that the markets are a little more bearish than we might have expected. The next point to note is that we are expecting an 80-day cycle trough to happen about now. And if we look at this composite model line, you can see price of gold is now expected to bounce up. Okay, we're going to form an 80-day cycle peak, but look at this interesting floating circle for the 40-week cycle peak, which is happening around about then. So we could expect an important peak, well, fairly important. It might be a 40-week cycle peak or at least an 80-day cycle peak in the middle of March, after which price is expected to drop again. We're looking for a 20-week cycle trough in April, and then we're expecting another peak over here, which is in May. Remember that when we're looking at cycles, all of these cycles are influencing price to move up and then move down and then move up and then move down. So you have to be constantly updating your analysis and your understanding of what is happening in the market. The bigger picture in terms of gold is that a very important peak most probably formed in the middle of last year, and we're certainly looking at price over the longer term moving down. We have this 18-month cycle trough over here towards the end of this year in about September, October, and so price is generally expected to move down towards lower levels towards the end of this year. I do hope you found this market update interesting. If you have any questions, please put them in the comments below this video. I look forward to hearing from you.